Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, to discuss Nasdaq-100 reconstitution taking place after the close today, December 16th, 2022. We'll also look at the performance of index additions and deletions in 2022 and how it's been driving the overall performance for the Nasdaq-100. Mark, it's great to have you as always. Welcome back to Trade Talks, and explain to the audience what the reconstitution is, the significance of it, and what it means for the companies being added or deleted.
Yeah, thank you, Jill. Great to be back, and a very timely recording to talk about the annual reconstitution. As you mentioned, this happens every December for the Nasdaq-100. It's really one of the most significant parts of the methodology, how we construct and maintain the index on an ongoing basis. So even though occasionally you will see other activity in the index over the course of the year in terms of additions or deletions, depending on things like companies getting too small, too big, having their weights adjusted, getting acquired and exiting for those types of reasons, December is really when you see the bulk of the activity. And so this obviously has an impact on some of the stocks that get added to the index, because we have a lot of AUM tracking, right? Just within the Qs, the ETF from Invesco, ticker QQQ, there's about $150 billion of AUM. Currently, there's billions of dollars of additional AUM tracking through other Invesco vehicles in the US, as well as abroad, as well as, with other issuers and different types of products outside of even ETFs. So it's a really, really big ecosystem in terms of the assets tracking, and definitely going to see some extra liquidity for some of the companies that enter into this index and start getting bought up by the ETFs and other funds that are tracking it.
Yeah, that's a great point. I mean, there were a number of products that launched this year globally that do track the Nasdaq-100. Let's talk about the companies that are being added and review their performance with us.
Yeah, so let's take a look at, first up, the 6 companies that are being added after market close today. You see the effective date of December 19th there at market open. Really, really interesting mix of companies, and I think kind of tells the story of what has been different with index performance and index dynamics this year versus the last few years, right? The things that stand out to me here, obviously, are the top 3, Baker Hughes, which is a company that switched its listing to Nasdaq about a year ago. You may recall GE spun off its oil services businesses several years before that to merge with Baker Hughes. This is basically just a big, oil and energy services provider out in the field. They're a market cap of about 30 billion. They're up 21% this year, in line with a lot of what the rest of the energy sector has been doing. You can see Diamondback Energy, ticker FANG, not to be confused with the old FANG, right, which is an acronym of some of the biggest tech names. But Diamondback Energy being, we believe, the first pure play energy and exploration and production energy company to be added to the Nasdaq-100 in its history. This one also pretty big, 24 billion, up a nice 27% year to date. A few of the other ads here that you'll see, these are more kind of technical additions to the index in terms of, Global Foundries, ticker GFS. That was previously spun off from AMD over a decade ago, the big semiconductor company. This one's ranked number 3 globally on a standalone basis in terms of semiconductor foundry services, the actual manufacturing that happens of semis. So this one IPO'd earlier in the year, and it's now eligible to join, market cap of 33 billion, definitely eligible. Actually not bad in terms of performance this year. And then Rivian IPO'd late last year, was a massive IPO, wasn't eligible yet in terms of seasoning, down 77% year to date, but still on the basis of its sizable market cap eligible to come in. And then Discovery, which is, a rebrand, kind of reorganization of a couple different businesses. The old Discovery Holdings, the media company, along with the Warner Brothers business from AT&T, that started trading in April of this year. Hasn't had a very good year either, down over 57% year to date, but still sizable market cap of 24 billion. You could see a few of those other names that came in earlier in the year, Enphase Energy, Old Dominion in industrial transport, and AstraZeneca in healthcare. Not much in terms of tech this year in terms of the new additions, either prior to December or right now.
Yeah, and let's talk about the deletions, the companies that are coming out of the index.
So here you've got, a number of companies that were added in recent years, names like DocuSign, Match Group, Splunk, names that had been doing very well and really have just kind of cooled off, right? It's been a challenging market environment for tech and high growth, especially names that are kind of earlier in their maturation process. So DocuSign and Match Group, the worst ones on here, down over 60% year to date. Splunk, not too bad, but that was one of the smaller names coming into the index this year. So now it is, no longer large enough to remain. And then you've got a couple Chinese ADRs on here with NetEase and Baidu. Those are not down quite as much year to date either, but also were among the smaller names heading into this recon. You can see a few of the other deletions here: Skyworks, VeriSign, some of your older tech names. And then earlier in the year, we had Peloton come out. Just last month, we had Okta, another name that has really struggled this year, down 70% after many, many years of outperformance. And then Xilinx, interestingly enough, another semis name. We talked about Global Foundries earlier, previously being part of AMD. Xilinx was actually acquired by AMD earlier in this year. So that's sort of the roundup of the index deletions. And I think that when you look at this overall, right, the activity that you're seeing this year with the index down about 30% year to date as of yesterday's close, this really does illustrate how unusual of a year this has been compared to the last, call it decade and a half, where you don't have much in terms of outperforming tech joining the index late in the year. It's really other sectors that are not well represented on the index, like energy, like industrials, healthcare, and real estate. And then a lot of the deletions are those names that kind of just missed the cutoff for the market cap because they were, underperforming most of the year. So that's the wrap on the recon.
Yeah. All right. Interesting, Mark. And you know what, for our newer retail investors that are out there, let's say they do hold the Nasdaq QQQ, is there anything that they need to do, or this is automatically done for them through the issuer?
No, the issuer takes care of it. We send them the updates. They place the trades. And their job is basically, their portfolio managers need to trade in and out of these names to match the index weights and composition as closely as possible to minimize that tracking error. So it's all being taken care of behind the scenes. No action for your average investor here.
All right, Mark, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.